You're going to have moving costs and running costs and things that you never expected because you bought the house and the seller didn't tell you that there was a hole in the roof or that the boiler was about to go out. So and don't forget, your home may be repossessed if you do not keep up the repayments on your mortgage. So let's get into this. First question that a lot of people ask is, when is a good time to buy? Now, that's one of those questions that is very unique to each individual. So the right time to buy is when you're ready to buy. Don't look at the marketing of the news talking about interest rates being up or interest rates being down. Look at the economy in your pocket, and then you can decide if you're ready to buy. So as they say, don't wait to buy and wait, because historically house prices go up in the long term. You may have some ups and downs in the short term, but in the long term, house prices are going to go up. How much can I borrow? How is it calculated as far as a mortgage? I've come up with something called CID, C-I-D, which is credit, income, and deposit. So what a bank will do, they will look at your credit profile, not just your credit score, but your credit profile. What I mean by that, your score may be high, but you may have missed payments in the last 3, 6, 12 months, which means you may not qualify for some products. Then they're going to look at your income. As a rule, they're going to multiply your income, so the amount that you make, by either 4.25, 4.5. It's going to depend on the type of job that you have and some other factors. So they're going to multiply your salary times a number. Let's keep the numbers easy and say you're on £25,000 a year, and they multiply it by 4. Then that would give you a mortgage amount of $100,000. So that's the amount of the mortgage you qualify for. But then let's just say you had £100,000 sitting around somewhere. You would take the amount of the mortgage you can get, which is $100,000, and add the deposit that you have, which is $100,000. So that means you could actually purchase a property for $200,000, because the $100,000 you're paying down would be deducted from the house price, which would leave the mortgage amount of $100,000. That leads me into loan to valuation. That's something that people ask about a lot. Loan to valuation, or LTV. Loan to valuation is the amount that the bank is lending you versus the amount that the house costs. So again, let's keep the numbers easy. If the house is valued at $100,000, let's just say, and their bank is lending you $75,000 because you paid down $25,000, that would be a 75% loan to valuation, because the house was valued at $100,000. You paid down a 25% deposit, which would be $25,000. That means the mortgage that the bank is giving you is just £75,000. How much do I need for a deposit? This is one of those things that gets bantied around a lot. People talking about a 5% deposit, a 10% deposit, a 15% deposit. Now, a lot of lenders, the top amount that they will lend loan to valuation wise is 95%. There are some mortgages on the market that go above 95%, but they're few and far between, and you'd probably have to have a really strong profile to qualify for a mortgage above 95%. I would say if you're one of those people that can afford to, you'd want to get at least a 10% deposit, because that's going to open you up to more lenders, because not every single lender is going to do a 95% mortgage. So 10% down is going to give you a 90% mortgage, and that's going to open you up to more lenders. Can you borrow the money for the deposit? I get asked this question all the time. So you don't have enough money for your deposit. You're wondering, can you borrow money from a bank to make the deposit for your home? In theory, you can. But remember, if you're borrowing money, then you have to pay that back. they're going to deduct those monthly payments from your affordability. So if you're paying a loan of £10,000 back and you're paying £250 a month, they're going to take £250 out of your disposable income because now you have to pay that money back. So ideally, you want to save money for your deposit. That way, that money is in your savings account. You can demonstrate that you have that money. But you may be one of those lucky people who someone's going to gift them some money. It may be a parent, it may be a rich uncle. Anyone can gift you money. Some lenders will not allow the deposit to be 100% gifted. They want to see that the individual has some skin in the game. Some lenders will only accept gifted deposits from immediate family members. And remember, it has to be a gifted deposit. If it's a loan, it's a loan. If it's gifted, that means you don't need to pay it back. You will need to provide a gift letter. That will be part of the things that the solicitor will ask you to provide when you're demonstrating how much of a deposit you have for your new home. What are the costs involved in buying a home? So yes, you have the deposit, but don't forget, if you come to me, you're going to be paying a broker fee. You can go directly to your bank and you may not pay a broker fee, but you will find that the service that you get from brokers is going to be a higher standard. Plus, you're going to get more choice by going to a broker because brokers work with multiple lenders. When you go directly to your bank, they're only able to talk to you about their products. You'll also have solicitor fees. And do not cut corners on solicitors' fees. If you are looking for the cheapest solicitor, it may end up costing you more money. Why? Because a loan, a mortgage, is only as quick as the slowest person. So you don't want a solicitor who is overloaded, or one of these solicitors that is in a panel and you have to do everything through web chat. You want a solicitor that you can speak to, someone that's going to be responsive. Because think about it this way. If you're renting and you have the cheapest solicitor possible, but you're renting, and because of that solicitor, it prolongs the deal by an additional month or 6 weeks, that's an additional month's worth of rent that you're going to pay. That's real money. So you may have found a cheaper solicitor, but you've ended up paying an additional month in rent. The solicitor will also be the person that protects you from things that could go wrong during the contract stage. They'll help you with the searches, etc. You'll also, depending on the cost of the home, be liable for stamp duty. If it's a second home, you will pay that additional premium for the stamp duty. So don't think about just the deposit. There are other fees that are involved. And if you're living at home right now, when Hope gets on the call a little bit later, she'll be telling you that living at home might be one of the best things you can do, because you can switch a light on and go in the other room and leave the light on. But when you're living by yourself, you're going to have those additional costs of running the household. A question that people ask me: why is my interest rate so high? My first answer to that is, compared to what? I was speaking to a client a few weeks ago and they were like, oh, I took my mortgage out 5 years ago and my interest rate started with a 2. I'm like, that's great. The interest rates aren't starting with 2s right now. So when you're asking, why is my interest rate so high? What are you comparing it to? Are you comparing it to someone else in another situation? Are you comparing it to what interest rates were 5 years ago? If you are working with a broker, or even if you go to the bank, they're going to find the cheapest product that you qualify for. So the interest rate that you get based on your profile will be different than what another person might get for their interest rate. Things that will impact your interest rate is your credit rating, the amount of the deposit you're paying down, your visa status. There's lots of things that will impact that. And remember, as a broker, I am regulated by the FCA. The FCA requires me to get my clients the cheapest rate that they qualify for over the shortest term. Being a broker is a relationship business, so there's no benefit in me getting you a higher rate than you actually qualify for. The best thing I can do is provide a great service that you'll be excited to refer people to me. So if you have a non-UK passport, that might impact your interest rate. If you've had to go to a specialist lender because maybe you've had some bumps in the past and you are unable to go to one of the high street banks, that will impact your interest rate. Freehold versus leasehold. Now, I grew up in the States, as you can probably hear from my accent, and it took me a while to understand this whole thing about freehold and leasehold. Simply put, usually most houses are going to be freehold, most apartments are going to be leasehold. There's also something called share of leasehold, which is still a leasehold. Keep in mind that if you do a leasehold purchase, that solicitors usually will charge a little bit more for the conveyancing. So it's a little bit more for leasehold because there's a little bit more involved. But what's the difference? A leasehold, it means that essentially the land that the property is on, you don't own. Somebody else owns that freehold. What you want to watch out for when you're purchasing a property is what's called a short lease. So you want to, as a rule of thumb, you want to try to find a property that has a leasehold of more than 100 years. The bigger the number, the better, but you don't want to go under 100 because some lenders will have restrictions on how much they will lend or the loan to valuation. And if it's a short lease, you might find that no lenders will lend on that property. There are some changes going through Parliament at the moment around leaseholds, but you'll have to wait and see. And maybe by the time you watch this video, things will have changed. But for now, try to avoid leaseholds that are less than 100 years. If you're buying a house, it's probably going to be a freehold. Should I buy an auction property? Now, people get excited when they see these beautiful properties being sold for hundreds of thousands less than you would think that it should cost. Well, there's a reason. My first caution to anybody who is considering buying an auction property is if you're not an experienced investor with a team of builders and know what you're doing, do not buy an auction property as a residential property. Now, if it's an investment property, that's something different. But if you're just trying to get a house on the cheap, ask yourself, why is it so cheap? It's probably being auctioned because it couldn't be sold. Some things to keep in mind. Will you be able to get a mortgage on that property? When you use the modern method of auction, it means once your bid is accepted, you have to purchase that property within 30 days, which means if you're getting a mortgage because you're not buying it cash, you need to find a lender that will lend on that property. And it's probably being auctioned because it's not mortgageable or there's some issue around it. So I would avoid auction properties at all costs. Your deposit is at risk because once your bid is accepted, that deposit that you pay down is non-refundable and you will have to get independent legal advice. There's lots of legal stuff that you'll have to go through in order to even just enter into the process. But no, you should not buy an auction property if you're trying to buy a property for your home, for your family to move into. What are the different types of mortgages? So you hear people talk about fixed rates, variable rates, tracker rates. Simply put, a fixed rate is what most people go for when they're getting a residential mortgage. A fixed rate is going to give you a fixed payment every month for a set period of time. The most common times are 2 years, 3 years, 5 years, and there's larger or longer terms than that. But most people tend to go for 2 or for 5. So you'll go for a 2-year if you feel that within the short term that interest rates are going to be going down. In that case, what you would end up doing is going for a short term. If you're worried that interest rates are going to be going up, then you'd fix for a longer term. That way it protects you against interest rates going up. And you have the peace of mind of knowing how much your mortgage payment is each month for that fixed term period. A variable rate is just that. It will vary. So it might track the Bank of England base rate, which means if interest rates go down, you may get a notification from your bank telling you your mortgage payment is going down in the next 30 or 60 days. Conversely, you might get a letter from your lender saying that interest rates are going up. So if you want stability, you're probably going to go for a fixed rate and not a variable or a tracker. And then there's also 2 payment methods. Either you're going to do a repayment mortgage or an interest-only mortgage. A repayment mortgage simply means that in the term, that's the big number in the mortgage, the 20, 30, 35-year period, at the end of that period, you will have paid off your mortgage completely. So each month, you're paying some of the interest and some of the capital. Over that term, that amount that you owe the bank is going to go down. At the end of the term, it will be paid off. Now, most people, because they will take out a fixed rate mortgage for a period of time, 2, 3, 5 years, whatever, at the end of that time, they'll do something called remortgaging, which is essentially when you either stay with the same lender or go to a new lender and you renegotiate the terms. So that's remortgaging. But if you have a repayment mortgage, it means that you will pay off your full mortgage balance by the end of the term. If you have an interest-only mortgage, that means every month that you're paying, you're only paying interest. So if you got a mortgage for £200,000, every month that you pay, your £200,000 outstanding will remain the same. At the end of the term, the bank will require you to pay back that full amount. Most people don't take out residential mortgages as interest only. They would take it out as repayment. Usually an interest only mortgage would be taken out if somebody is doing a buy to let. Sometimes people take it out because they can't afford the repayment mortgage. It can be risky, especially if you don't have a repayment vehicle at the end of that term. I have been talking to a lot of people recently that are a little bit older and are in a bit of a bind because they took out interest-only mortgages. They're now 57, 58. The bank is saying, well, you now owe me £250,000. They can't get a remortgage and they're a little bit stuck. So just be really careful if you're doing an interest-only mortgage unless it is a buy-to-let property. Timelines to buy a new home, it takes longer than you think. 4 to 6 months. 50% of all mortgages do not go through. So keep that in mind. It's not as easy as it seems on television. If you're doing a remortgage, it's 7 to 10 weeks. A product transfer, which would be you're currently with a particular bank, you're just switching to a different product with that same lender, that's 1 to 2 weeks. Now, additional expenses. As I was saying, and Hope will elaborate on this, if you're living at home, you're probably not thinking about the additional expenses that are involved in owning your own home. So you hear a lot of people like, oh, I'd rather be paying a mortgage than putting some money in someone else's pocket by paying rent. Keep in mind, when you pay rent, if the roof falls in, if the boiler breaks, if something goes wrong in that house, the landlord is responsible for that. When you own the property, you're responsible for everything. So when you purchase the property, you're going to have the cost of moving, you're going to have solicitor's fees. If you're buying a house, you're required by law to have building insurance. You're going to have moving costs and running costs and things that you never expected because you bought the house and the seller didn't tell you that there was a hole in the roof or that the boiler was about to go out. So always assess if you're going to be able to afford this new place. You're going to need protection. There's going to be other things that you need. But we're going to talk a little bit about running costs. So we're going to shortly be bringing in Hope, and Hope will be giving us some information, some hints, and some tips on how to save money on your utilities.